good afternoon, good morning to all of you joining the session today. I'm thrilled to have the opportunity to moderate this first panel, and I'm going to do a quick introduction to my panelists who I know are going to join me here, and you can find their full bios on the virtual program. But I'm joined by Kristen Leuz of the University of Chicago, Jessica Mann of Wells Fargo Asset Management, and Neil Stewart, the Value Reporting Foundation. So I see my fellow panelists online, and let's jump in. As introduced, as Julie mentioned, as well as Mark, the importance, the attention to ESG disclosure cannot be overstated with the attention and just the coalescence around the critical nature of ESG from both a risk and opportunity standpoint to the capital markets, to society at large. I think we've seen this sort of convergence around ESG as a data-driven way to understand long-term value. And when you really see how that definitional clarity is taking shape, where we're understanding the impacts and dependencies of a business on the environment and society is becoming more clear. And disclosure is critical to delivering on that critical insight. I think the dimensions, the pillars, if you will, of E, S, and G, while broad and broadly encompassing in nature, really manifest in different ways for different organizations across different industries. The E, more traditionally understood, energy, water, waste, and other forms of impacts and dependence, the growing attention to the broader climate agenda, but not at the expense or deprioritization, which actually we're seeing quite the opposite of many of the areas of performance under the S, and importantly the G, and how an organization is intentionally organized to really deliver on an organization's strategy and manage that risk. So clearly the investment landscape, the capital markets are prioritizing ESG, and we're going to unpack a little bit of this through this discussion. And again, really thrilled to have all of you on the panel today. So Kristen, maybe we'll start with you to really focus in on that investment landscape. So we've seen sustainable funds in the US have continued to grow at record pace, more than doubling total from 2019, reaching 51 billion in 2020, and that was 10 times more than the flows in 2018, according to Morningstar. Certainly an indication that there's value, there's risk, there's opportunity to investors with an intentional focus on ESG and that understanding of how boards and organizations are intentionally focusing on performance. So with that as the backdrop, to what extent do ESG investments really deliver outperformance?
Yeah, hi Kristen, and thanks to you and the CAQ for having me on this distinguished panel. That's a good sort of first question. The evidence on returns, as far as I can tell, is at best mixed and actually still quite heavily debated among academics. And what I thought we could start with is first conceptually ask, why should green investments have different returns? And so one explanation could be that there's differential returns because investors require higher compensation for risks associated with poor ESG performance, carbon exposure. So the idea would be brown firms, loosely speaking, have higher risks and higher returns, and green stocks, it's the opposite. Another story you could tell or explanation could be that investors have ESG preferences. They get utility from green stocks, and in that case, green stocks should offer a lower return because investors get additional sort of non-monetary benefits from these investments. And so under this theory and the idea that shifts in consumer tastes for green products or investor tastes for green holdings can explain why the green stocks have delivered really high returns in recent years, and especially during the COVID crisis. But importantly, under either of these two explanations, risks or preferences, firms with strong ESG performance would offer lower, not higher returns in equilibrium, because either investors enjoy holding them or because they have lower risks and therefore provide a hedge, say, against climate risk. So from that perspective, the recent evidence that's come out sort of makes a lot of sense in the context of these ideas. Now, to be clear, there is evidence of positive alphas or superior returns for ESG stocks, especially again in recent years and during the COVID crisis. But what the academics are debating is where these returns are coming from. And that's sort of where the debate is. And one claim is that we're seeing these returns because they might also align with standard asset pricing factors, and that the documented outperformance in the alpha computations don't quite account for those standard factors. But in my mind, the most likely explanation is that the recent demand for ESG investments that you cited in your opening question, all the demand for sustainable mutual funds and green stocks, the growing recognition of climate risks lead to greater attention and demand for green stocks or green investments. And as a result of that, it's basically driving the prices up and generating the returns that we're seeing, right? But again, the long run expectation would be the opposite of that. That is lower returns for the green stocks. And again, much of the evidence that I've seen more recently would be consistent with that.
Yeah, that's really helpful, and I think helps to paint that picture more broadly as we're seeing the coalescence around the capital markets and expectation. And maybe turning to you, Neil, with the sort of the foundation of conditions necessary in the market to really allow this investment landscape to evolve, there's got to be data, and data is provided through effective disclosure, and there's a lot happening on the disclosure landscape. So could you speak a little bit to the various forms of ESG disclosure, and from where you sit, how you see disclosure evolving in the context of this changing investor landscape and set of expectations?
Thanks, Kristen, and thanks very much to the CAQ and to Crow for having me here today and having me represent the Value Reporting Foundation, which was created out of the merger of the Sustainability Accounting Standards Board and the International Integrated Reporting Council just this summer. So yeah, there's a tremendous amount happening in the sustainability disclosure landscape. There's a tremendous amount happening in sustainability, period. I love the way you put it, Kristen, that ESG is a data-driven approach to understanding long-term value. And let's remember that this term ESG is relatively new in the larger context. And I would wager that all of us could think back before the pandemic, and think to those few months in late 2019, when suddenly ESG was everywhere. Suddenly we kept hearing about ESG. It wasn't just in a corporate or investor circles or accounting circles, it was in the popular consciousness. And in fact, it wasn't just us, because we're all immersed in this. If you look at media mentions of the term ESG in the last few months of 2019 and the beginning of 2020, media mentions were growing exponentially. They were rocketing upwards through the roof. So ESG is all around us, but where did this come from? And think back also to how ESG disclosure has grown. So ESG disclosure or sustainability disclosure grew over many years and long before this explosion in ESG investment. And it grew in response to the needs of different audiences. So traditionally narrative-based disclosure aimed at different stakeholders, a multi-stakeholder audience. NGOs, perhaps regulators, employees, and customers, and society generally. But then after the financial crisis of 2008, ESG and non-financial factors began to be recognized as business risks. ESG entered the popular consciousness. It moved into mainstream investing. And that's really when we start to see this move away from narrative towards data-driven reporting, as well as integrated reporting, so connecting the financial and non-financial sides of the corporate story. Along with this came an explosion in the ecosystem, questionnaires, ratings, and rankings, and yes, standards and frameworks, as we'll get into talking about later. Really, when it comes down to it, though, what this disclosure is trying to do now, this new form of data-driven disclosure, it's trying to be decision useful to investors. So what investors say very clearly, they don't want more disclosure, they want better disclosure. And by better disclosure, they mean it has to be consistent over time. It has to be comparable between companies, and it has to be reliable. So let's go to the comparability part of it. To be comparable between companies, we need to get down to industry specific, because sustainability is not one size fits all. What matters to one industry matters quite differently in another, or doesn't matter at all in another industry. So that's what matters to company performance. It ultimately matters to investor performance. What is financially material over the short, medium, and long term? Now, the challenge we're at today is getting to clear standards, because why do we need standards? Clear standards really ensure that consistency over time, comparability between companies, allowing investors and management and boards to really better integrate ESG factors as both opportunity and risk, and to make much more informed decisions. So this is where we've gotten to from a narrative history of ESG disclosure towards a real data-driven, financially material and industry-specific approach.
Great. Well, thanks so much, Neil. Really, really well said in sort of framing, how we've gotten to where we are. Unfortunately, it looks like we have lost one of our panelists who we wanted to bring in next to bring that investor perspective, Jessica Mann, but we're hopeful that she will be. Oh, it looks like, Jessica, do we have you?
I am here on the phone, if you can hear me.
Great. Yes. Well, we can hear you loud and clear. So we wanted to kind of build off the comments that Neil was just sharing in terms of the consistency, the comparability aspiration, and some of the challenges with this form of disclosure, and really how we've seen the market evolve. I mean, today there are a number of disclosure requirements that fall within this broader remit. When you think about human capital management disclosures that are required today, executive compensation, board disclosure. So maybe if you could speak a little bit to, where you sit and how institutional investors look at the information that is provided today, I guess building on that decision usefulness point that Neil mentioned, the sufficiency of where we are today, even with this evolution that we're seeing. Maybe speak a little bit to where that information sits, how you access it, and where maybe perhaps where you see this headed.
Okay, great. And I apologize. We seem to have had a sudden brownout here. I'm in the Bay Area. I don't know if it's related to wildfires, but I certainly didn't stage this to emphasize climate risk. Anyhow, yeah, so I did pick up on what Neil was saying, and to us as investors, it's critically important. We have supported the SASB work for a decade. We just really appreciate the degree of industry input and expertise that was sought in establishing the standards. And industry-specific standards are really important to us because it really does allow us to cut through the noise of sustainability disclosures and hone in on those ESG issues that are material to investors. By that, I mean these are the issues that are going to affect the financial condition of a company, the operating performance of a company, the risk profile, which goes on to impact both market value from an equity perspective, the cost of capital from a fixed income perspective. And this has just become critical in the way that we have integrated ESG research into our investment mosaic. We are an active manager at Wells Fargo Asset Manager and Management, and that is just something that's been critically important to all of the assets that we manage, and the way that we are able to assess companies on a global basis. So what you referenced is great. It's referring to the U.S. regulator, but global consistency is really important to us, and our universe does reflect that global nature. So while it is a voluntary standard, we are really encouraged by the take-up globally of the SASB standards, and we use these to really frame our own opinions on companies from a qualitative perspective and a quantitative perspective. So some of the disclosures and metrics are quantitative, and in other cases, the qualitative statements that are part of the framework are also very insightful to us, because we believe that companies are on a journey with respect to their sustainability performance. And we want them to start somewhere with disclosure and build upon it. The other framework that we are very supportive of is the TCFD, the Task Force on Climate-Related Financial Disclosures that was set up by the Financial Stability Board. And this is another framework related to climate that's really it's very useful to us for companies to be able to make their disclosures within this industry standard. Well, what we do with it is that we have gone on in our own evolution with ESG information to take vendor data that we receive from the likes of MSCI and Sustainalytics, and framing these opinions on companies. But we've put a lot of resources into developing our own ratings on companies, and so we're using the SASB framework, which issues under the E, the S are important, and then our analysts are actually framing performance of companies relative, so leader, laggard, average, and we also add on a directional viewpoint to that, whether improving, stable, or deteriorating accompanies those types of views that our analysts have on companies. That gives us a forward perspective, which is another advantage that we think we have as fundamental analysts compared to what we buy from the likes of MSCI and Sustainalytics, which is more backward looking in nature.
Great. Well, thank you so much, Jessica. And I think just to put an emphasis, I think you said it so well in terms of a recognition that every organization, every company is on a journey, and you've got to start somewhere. And in the spirit of this enhancing the efficiency of this ESG data flow, really that insight into how investors are looking at performance, understanding that performance through data is really critical. I did want to remind the audience as we continue on, we'd love to gather your questions through the chat function. So please, pop your questions in there, and we'll hope to leave time at the end of the panel here to address, or if we can weave them in, we will certainly try to do that. So please do share your questions. So I think, building on the point and sort of that insight from Jessica and where we started, there's clearly a move as we continue to see the regulatory regime taking shape here in the US, globally, and a number of markets. And so I think we're clearly going to see a focus on what regulation will mean in terms of catalyzing behavior and how that will take shape and over what time period. I think, Kristen, just wanted to bring you back in particular. You've have a recent paper, the Mandatory CSR and Sustainability Reporting and Economic Analysis and Literature Review, where you really collate some really powerful economic information, the effects of mandated disclosures for CSR, corporate responsibility, responsitivity, and sustainability topics, and how ESG disclosures impact a company's value and behavior. So I'd love for you to just speak a little bit to that analysis. It seems somewhat unique, and especially at this point in time, this critical point in time in the market where we're rapidly moving to a regulated regime from a US as well as global perspective. Would love to hear a little bit more about that analysis.
Sure. And yeah, I mean, this is I should say the report is actually pretty long. It's about 100 pages. So being able to sort of summarize it in just a few sentences is probably impossible. But let me kind of touch on a few key things that I've at least learned from the exercise and going through sort of, as you said, collating what are some of the potential economic effects of mandated disclosure in the ESG space. So first, I want to note that companies already have to disclose sustainability information or ESG information to the extent it's financially material, right? Most reporting systems, and certainly the SEC disclosure system, is based in materiality. And so it doesn't distinguish, the system doesn't distinguish between information that's ESG related and traditional information, and then would say you only have to provide the traditional financial information. The relevant question is it financially material? And as Jessica noted, investors are trying to price the ESG risks and exposures that companies have. And so the relevant question, I think, for the current regime is, do investors obtain all financially material information in this ESG space? And I think given how investors have been vocal and supportive of recent efforts towards a mandate suggests that they're probably not. Furthermore, we should see that when it comes to climate or the environment, we're dealing with externalities, right? Firms do not necessarily face the full social costs of their actions. And that almost by definition means that some of the information about the corporate impacts are not financially material because the underlying actions have externalities. So think if firms can emit CO2 for free, then it's not clear whether the CO2 emissions disclosures would really, or disclosing about them, would necessarily be financially material. And so therefore, the key question for the effects of a mandate is, will the mandate be limited to just financially material information, or go beyond that and include company impacts on the environment and society? The latter is what people often call double materiality or an inside-out perspective for these ESG disclosures. That would be a much more substantial expansion of what firms currently provide voluntarily, or some firms provide voluntarily. The former, if it's based primarily on financial materiality, would be less of an expansion. And here, standards would serve more as a clarification of what actually is material in a given industry, like Neil was saying earlier, and what this would mean or what information should be expected. And so in terms of the effects of a mandate, one of the key questions is, are we going to be in the former or the latter? And that will greatly impact on how big the effects will be. And so that's sort of hard to know without knowing more what exactly the mandate will look like. What we can say, and what we describe in detail in the report based on existing research, is we can be quite confident in the types of effects that we're going to see. So first of all, if a mandate brings out new and material information, then based on all the research we have, we can quite confidently say that this new and material information will have the typical capital market consequences. Investors will price it. We should see liquidity effects, so meaning liquidity should improve as information improves. The cost of capital should likely decline as information improves. Capital allocation should improve. Better information typically also means better oversight. That should, directionally lead to better corporate decisions. So there's quite a few benefits. There's also costs. And so on the cost side, I would want to point out, and this jives or connects with what Neil was saying earlier, that some of the ESG information that's really relevant to investors is going to be fairly granular. It's going to be process oriented, and that has the potential to be proprietary, right? This could be of interest to competitors, and to the extent that competitors can use that information, it could blunt the incentives for firms to innovate in the first place. The final category I want to quickly touch on, because it's very important, is there can be effects related to the behavior of the firms themselves. So in economics or in accounting, we'd call them real effects because the corporate behavior and the actions change rather than just the pricing of the firm. And these effects come about because firms anticipate that the stakeholders will respond to the information. And here we don't only have to think about capital market participants, but also other stakeholders like environmental groups and so on. They might exert pressure on the firms, and then firms adjust their behavior. Now, some of those real effects, or some will say that these real effects are exactly what we need to address the sustainability issues, right? That's why we need sustainability reporting, would be the argument. We want firms to behave in more environmentally friendly ways, to consume fewer resources or emit less greenhouse gas. So this is sort of the sunlight is the best disinfectant kind of idea. But as we discuss in our paper, these behavioral changes are very hard to predict, right? It's hard to know whether the disclosures impose the right cost on firms and on the right actions. And that is why sort of a disclosure regime is not necessarily benign. It's a powerful tool, but we shouldn't think that it won't have, potentially serious unintended consequences that we should think about. And that's something we kind of highlight in the report. Let me stop here and, let the others chime in.
Yeah, I know that was a great overview and a lot to unpack there. Certainly would just welcome if Neil or Jessica would like to weigh in there before we move on.
I think it's very well put, Kristen. It's fascinating. Look at as you say, it's a balance, right? There's costs, but there's tremendous benefits as well. And I hope we can find that right balance.
Mm-hmm. For sure. Well, thanks again for that overview and really powerful analysis. I think we do want to pivot to more of a deep dive into the standards and frameworks, right? This market infrastructure that's continuing to evolve and accelerating rapidly. And Neil, naturally, I'll come back to you as we look at the various standards, frameworks, sometimes affectionately referred to as the alphabet soup of initiatives. That really help companies focus in on how to prioritize, how to think about what they're managing, how they're managing it, what the risks and opportunities are. In particular, there's been a rapid move towards a coordination, a very intentional commitment to work together. SASB was very much in the lead in some of those activities over the past year. And so could you just talk a little bit about this move and how it's really positioning the various different actors to really move towards this rationalized, harmonized, or make steps towards moving towards a rationalized and harmonized landscape?
Yeah, this is a great question. And the alphabet soup, I mean, this is such a big pain point for preparers, for issuers, for the accounting profession. This is apparently dazzling array of standards and frameworks. I actually prefer, instead of alphabet soup, I prefer to call it a jigsaw puzzle, because I do think that the pieces can fit together into a coherent picture. It's not just chaos. The other thing too is the number of standards and frameworks. I frequently see a reference to 200 frameworks and standards that companies have to grapple with. Or I saw one article in the FT that talked about 600 frameworks. And look, when it comes down to it, there are actually, I can count them on one hand, the standards and frameworks that account for the vast majority of public disclosures on sustainability, right? And they do include the ones that SASB is one, the GRI, or formerly known as the Global Reporting Initiative, the CDP for questionnaires, disclosure on climate and water, of course, the TCFD, now the Task Force on Climate-Related Financial Disclosures, and integrated reporting for that matter. These frameworks are used around the world, and these are the ones that we need to focus on. So yeah, you referred to the work that we did last year, the so-called Group of Five. So this is where SASB, the IARC, GRI, CDP, and CDSB, the Climate Disclosure Standards Board, came together, kind of with the silent partner of the TCFD. They weren't officially involved, with the guidance of WEF, the World Economic Foundation, and we started to visualize this comprehensive system of corporate reporting. We really started to get to a vision of what a future system of corporate reporting could look like, and especially how the different standards and frameworks complement one another, and how we can begin working towards simplification and harmonization, right? So one very important thing to remember, and this goes back to what I said at the very beginning, how different standards and frameworks grew up in response to the needs of different audiences. And that remains the case. That remains the fact is that different audiences have different needs in terms of information. So the GRI is a multi-stakeholder framework, set of standards. It's meant for various users with various objectives who really want to understand an enterprise's positive and negative contributions to sustainable development. SASB standards are investor focused, and they're for users with a very specific interest in understanding enterprise value. You know, Kristen talked about the concept of double materiality. One of the things that a sort of development or expansion of that the Group of Five laid out was what we call nested materiality. And that is the notion that you have this large set, this universe of sustainability factors. So, and these are a company's impacts on society and environment. And then you've got SASB acting as a filter to identify the subset of those factors that have a material impact on the company. All right, so sometimes you think of it as one or the other, but nested materiality really very clearly shows that it's more a subset and that there's a tremendous overlap. So if you think, for example, the example of emissions that Kristen mentioned, maybe there's no explicit cost in terms of something you can put on your income statement, but there is a cost in reputation, in license to operate, in local communities and ability to attract employees. There's so many costs that an investor would factor in beyond a simple, say, carbon tax or an actual line item like that. So again, SASB captures that subset. And what we laid out with the group of 5 was a vision for how these different pieces can work together, can be and complement one another. One of the key things that we're working toward, that we're focusing on, is what we call interoperability. So just this idea that really a company should be able to gather the data and analyze it once, and then report it through the right channels to the right audiences. So they shouldn't have to grapple with different metrics and definitions for really the same topics, say emissions or diversity or cybersecurity. There should be some agreed upon metrics and definitions. So that's one of the things that SASB and the GRI are working on. Now, the other thing that this work produced last year, very important, was what we called a prototype climate standard. We unveiled that at the end of November, beginning of December. And essentially what that is, it takes the different pieces, the different elements, including SASB, including the TCFD, very importantly, and constructs what a recognizable accounting standard. I call it TCFD plus. It takes the very elegant principles-based framework of the TCFD and it kind of colors in the lines, and it adds the industry-specific topics and metrics that SASB brings to it. So this is a very important piece of work that kind of maybe shows the path forward. So I hope that gives you a little bit of a sense of how I see the alphabet soup, which is actually much simpler and more straightforward than maybe it's commonly perceived.
Yeah, well, thanks so much, Neil. I thought that was really, really well said, and I love the concept of jigsaw and sort of the constructive tone that sets versus just this is just a bunch of chaos. But I think that's a really important point that most preparers are navigating. It's different units of measure, different criteria that do vary across these different initiatives. So it's great to see that progress is being made, and great to see that many of you are chiming in on the chat. So we do have a few questions. Maybe just briefly, Neil, there's a couple of questions focusing on industries, and I think even as you talked about the work of the Group of 5, the Alliance, as you think about the ways that some of these performance areas do vary by industry, and there is a compelling reason that some of the measurement considerations may be different across the same topic area. So maybe just a brief word on that industry emphasis in this work.
Well, sure. You can take almost any topic and you can see clearly how it might be applicable to one industry, but not in another. So take something, just something simple like water management. Water matters to a beverage maker, but it doesn't matter to a software company. Whereas cybersecurity matters to the software company, but not to the beverage maker. Where you get slightly more nuanced is where you have the same topic, but that manifests itself quite differently across different industries. So again, climate risk, you take climate risk, and obviously certain industries are very, very impacted by, for example, emissions and what that's going to mean going forward. But what about product design? So you can say climate risk, well, it applies in terms of product design or supply chain management or disaster, like preparedness for physical events of climate change, like a healthcare provider needs to be prepared for that. So you've got the same topic, but applied very differently in different industries. So that's just a little bit of a sense of how, again, different topics for different industries and the same topic, but manifesting itself differently in different industries.
Yeah, no, thanks, Neil. That's really helpful. Maybe Jessica, back to you in terms of building on the comments you made previously and really focusing a little bit more and as it relates to the companies that you do invest in particular the larger sort of S&P 500 companies. What is that information that is most useful to you, and sort of what are those attributes of good disclosure that you look for?
Well, I think a more recent development for us and for others in the industry is designing ESG explicit investment strategies and funds. So we just launched a climate transition investment grade credit strategy, for instance, and then followed that up with a strategy. It's basically 2 degrees less than 2 degrees aligned equity strategy for its climate change as well. So strategies such as these have very rigid requirements around the companies that are included, and we are using this proprietary research that we've been building on for years to really guide this, where companies need to be demonstrating that they're on track, that they're not just making a commitment towards net zero by 2050, that they actually can demonstrate that they have a strategy in place, they have the governance in place, they have metrics and targets, the leaders are being compensated on achieving those targets. So this whole, I'm just giving an example on climate, but strategies such as these will have a very rigid requirement around what gets included and what doesn't. We recently tied this to our engagement strategy. I lead our stewardship efforts, and we were challenged by the investment team to really get our arms around the airline industry and whether or not airlines belonged in this climate transition strategy, for instance, because this is an industry that's very, it's obviously challenged to deliver on net zero, but we wanted to get our fingerprints on what they were specifically doing individually and as a whole. There's a lot of good work going on, but the reality is that the industry is pretty much still committed to only reducing emissions by 50% by 2050. So, I guess what I'm trying to express is that for ESG explicit strategies, we're going to be really looking for candidate companies in the portfolios that demonstrate that they're cut above the rest. And it still matters in our mainstream strategies. Most of our client reporting these days, even if ESG is not an explicit component of the guidelines that the client is giving us, clients love to see what characteristics in terms of ESG their portfolios look like relative to mainstream indices, and that's become really part and parcel of what we're delivering to them on a regular basis. So what gets measured gets managed, and it certainly contributes to a very rich conversation that we can have around ESG objectives that our clients might be interested in discussing with us.
Great. So that's really helpful. Maybe Kristen, back to you, just continuing on this standardization, lack thereof of uniformity of standards today. Based on your research and your just perspective that you bring, is there evidence that standards and frameworks, either on a standalone basis or in tandem, really promote market efficiency, that sort of efficiency in the data value chain?
So I think Neil already made a pretty good case or provided a number of really good arguments for why comparability is important, right? It's both from a cost perspective of the companies as well as from investors that are trying to process information produced under different standards. Comparability is clearly important. And I should say from sort of what we looked at in terms of research, better comparability essentially has similar effects or properties as better information, because it lowers the cost of investors, analysts to process the information. And so in that sense, it makes the same information more effective, and then you get similar effects like the ones I described earlier in terms of capital market effects and so on. But it's important to distinguish here between comparability in reporting and the actual numbers, the practices that people get to look at, and the uniformity in the standards. And the standards here are, and that, unfortunately, the debate most of the time focuses on the standards. And the standards are clearly an important and a critical input, but it's only one of the inputs. And so if I've learned one of the things that I've studied very carefully, which is IFRS adoption around the world, is that standards alone are not enough. And they possibly do relatively little compared to some of the other tools that we have. It's the comparable practices that matter in the end and that yield the benefits. But in order to get comparable reporting, that requires more than the standards, because firms continue to operate in different markets, will have different incentives, they're in different regulatory regimes. And so I would say markets have learned to operate with a limited set of standards. We see that with US GAAP and IFRS. We didn't land in one, we have two. Having one set on some dimensions would be more efficient than having multiple. Many is certainly not likely to be efficient. But in my mind, this debate focuses too much on the standards. And I would, if I could have my way, I would say getting a single global set of standards is less important at this stage, at least, because I think we can put the jigsaw puzzle together in the way Neil said, and instead make sure that the standards that we impose on companies, that they're being enforced and that there's assurance around this information. That is what, from the research I've seen, for instance, in international accounting, would say is likely going to move the dial more than necessarily getting down to a single set.
Yeah, well, and it's interesting too, because those other mechanisms that you're speaking to somewhat, will very much benefit from a consistency in a set of recognized authoritative standards. So it somewhat is a bit of a,
they interact, absolutely.
Progress at scale, for sure. While you have the floor, we do have a question that came in terms of unintended consequences, as you touched on, thinking about mandatory disclosures that may take shape across jurisdictions, and how might those considerations play into a potential global standard. So maybe just at a headline level, any reaction to that question?
I think we've had similar discussions also when it came to the time for the US to consider whether they should adopt IFRS or not. And one of the frequently mentioned factors here is, there's differences in litigation regimes. For instance, the US is known to be a fairly litigious system compared to others. These factors can play a role in both positive and negative ways. I think the US is also a system that has very robust assurance, very robust enforcement of the kind of standards when it comes to reporting. So those are, in my mind, positive factors. And so I think there will be international differences. And that is also, again, why I was just saying, if you impose just a single set of standards, it doesn't mean you're going to get, very harmonized reporting around the world, because these other factors continue to differ.
Yeah, no, it's a important part of this whole dynamic. Maybe back to you, Neil, recognizing we're coming down to the end of our time shortly here. Just maybe at the headline level, should convergence to one standard be the objective?
So this is what companies always ask, right? They say, when are we going to get to one standard? And everyone wants that simplicity. But as we've been talking in this hour, different audiences have different needs. We're never going to get to one single standard. What we will get to is one system that we all understand, somewhat like the financial reporting system. Like, remember that, before US GAAP, before IFRS, there was a patchwork of different ways of understanding financial value. But now we have one common system that we understand around the world. So we'll get to a system that we all understand. Building on what Kristen was just talking about, and this question about the unintended consequences, and can there still be country by country differences? So what we're working toward now is this building block approach, right? And this is something that the Group of Five laid out in our work last year, that IFAC has set out, that IOSCA has signaled support for, and that the IFRS Foundation has said they're working toward as well. So the idea is that there will be one single global baseline of sustainability accounting standards focused on the information needs of providers of capital and focused on the information pertaining to enterprise value. That's one building block. The other building block can be regional policy oriented, or values oriented, or goals oriented level of disclosure. For example, in the EU around the Green New Deal and a lot of sustainable development goals that EU countries share, they can have another level of disclosure on top of that. Or in the US, with our special circumstances around whether it's energy or healthcare or other industries, and other needs for US society, we could have specific disclosure on top of a global baseline. So that's a little bit I think, about how things will develop with this, that building block approach.
Yeah, no, that's super helpful, and to really unpack it that way. And I think as we transition to just a bit of a focus on the regulatory landscape and where it's headed, as we look to round out this panel, just I think building on this importance and the critical urgency around more clarity around standards. We just saw this morning that IOSCO released a consultation on ESG ratings and data providers. If you think about the whole ecosystem and those different levers and challenges, if you will, to driving this efficiency in the market, and where there is a tremendous amount of fragmentation that just continues to be perpetuated. And I think back to your earlier point, Neil, this sort of blurring of standards versus data requests that continue to accelerate in the absence of consistent, accessible, reliable, meaningful ESG disclosure. So I think it's a good transition into how we're looking at the regulatory landscape as it's taking shape, given IOSCO is playing such an influential role, sort of pulling in the securities regulators around the world to really lean in this whole evolution in the market infrastructure and the standard setting landscape. So maybe staying with you, Neil, since you have the floor, as you look at, we've seen a lot coming out of the SEC, out of the EU, other parts of the world. Where do you see the regulatory changes on ESG disclosures headed, and when?
Let me just check my crystal ball for a moment, because if only I had one. There is so much going on, as you say. So we've got the new CSRD proposal in the EU, right? The Corporate Sustainability Reporting Directive. Well, and that's going to be double materiality. That's going to cover the inside out and outside in, and it's going to be for private companies as well as public companies. It's going to mandate assurance, limited assurance to start, and reasonable as time goes on. All eyes on that. They're developing ESG standards, disclosure standards. They should be ready by next summer, ready for the 2023 reporting year, for 2024 reports. The IFRS Foundation is going to be setting up the ISSB, the International Sustainability Standards Board, by this fall, unveiled, ready to go by COP26 in November. They're promising a climate disclosure standard by next summer. Again, ready for the 2023 reporting year, reports in 2024. So look at those two developments. And then meanwhile, the SEC has on its calendar rulemaking around climate and human capital disclosure. So we expect to see that this October. We expect to see a climate disclosure rule proposal draft, and perhaps also human capital management disclosure. So I don't know quite what shape it's going to take. One big hope is that these different efforts will be coordinated, because we don't want more fragmentation. We don't want more confusion. They have to work together, and we hope that they all work with this idea of a global baseline with then further building blocks on top. Let's see how that pans out. The SEC is part of the IOSCO steering group, looking over the technical work of the IFRS Foundation, setting up the ISSB. The SEC is co-chairing that group, so clearly they're behind international standardization. The EC has also signaled cooperation. And of course, SASB is deeply, deeply involved in these efforts. SASB, the Value Reporting Foundation, we're supporting the IFRS Foundation. In fact, we're supporting all of these efforts, and we're really hoping we're not fighting, we're building this future corporate reporting system.
Yeah, no, thanks for that rapid overview. And I think it's been really encouraging to see some of the announcements over the past couple of weeks with commitments around some of the collaborative efforts across all of those different initiatives and market actors, as you mentioned. So we do just have 1 minute left. So any final parting comments? I don't know, Jessica, maybe over to you as it relates to what's happening on the regulatory landscape or more broadly.
Well, I would just add that we do have, we have sympathy, we have respect for the cost to companies that all of this is places on them, but you know, when you look at the cost benefit as we do, you know, we also think that this is just back to the opening theme. It does improve the information that helps us make better informed investment decisions. And, you know, sunshine is the best disinfectant ultimately. And so, you know, the more disclosure that's out there, for us, the better, to the extent it's regulated, you know, puts a sort of fine tuner on that. But at the end of the day, we do appreciate to companies that this is not coming without a cost and a commitment to develop expertise in-house to be able to do it.
Great. Well, thank you so much. I think we are at the top of the hour, so I think we'll have to land it there. We could have gone on for much longer, but I really want to thank my panelists, Kristen, Jessica, and Neil. I thought this was a really exciting discussion, and I know tees up the next panel very well. So we will conclude for the moment. We'll have a short break and come back at about 2:10, so in about 10 minutes. So thanks again, everyone, and have a good rest.
Thank you.